please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, on that note, let's move on to another story. Yash Jain caught up with Anant Goenka of Ceat, one of the tycoons featuring in Forbes India Tycoon of Tomorrow. Here's a snippet of that conversation.
We have seen nearly, 20% increase or more than that in the last, say, 3-4 months in terms of crude prices. So that will certainly put some pressure on margins. And with rupee at where it is, to that extent, there is some impact on that as well. So while not so keen to give guidance, but I'd say certainly there's pressure on margin.
Are you actively considering a price increase, considering the crude prices, and you'll have to, of course, pass it on to the end consumer? Are there any indications that we could have a price increase anytime soon?
Yes, absolutely. So about YTD, we've done about 2% price increase. Okay. I expect at least a couple of percentage price increase happening in the next 10-15 days. And then possibly in the next month also, we will look at further price increases.
We've seen the Kerala floods impacting the business in the state, in a very significant way. What kind of challenges do you see coming as far as the production or the supply concerns from that particular state are concerned?
Yeah, supply has really come down. There has been about a 20% difference in terms of demand and supply of rubber in the last year and a half. But I'd say in the last 2-3 months, this gap has gone up to about 50%. So consumption in India is double that of what rubber is produced. So everyone has to be more dependent on imports, at least in the near term. We have to wait for things to stabilize, and then hopefully supply will come in. On the other hand, rubber is a global commodity. So therefore, to a certain extent, Indian prices will depend on what global prices are. Global prices have been relatively stable, except for the rupee. Right. So to that extent, imports have become a little bit more expensive.
And the ROE is somewhere around 11%. The industry average, if you go to see, is around 13.5%. Right. What kind of further improvement do you expect as far as ROE is concerned? What is the margin in which we can expect the ROEs to remain?
Right, so we've been doing a lot of investment in terms of setting up new facilities, and this is expected to continue. Usually the returns ramp up once your capacities have ramped up. But I think we will be in an investment mode for the next at least 2 years. So your investments will be very high. Returns come in shortly after. But it's a way, I'd say that we expect ROEs to be a little depressed in the near term.
Your debt to equity ratio also, if I'm not wrong, is about 0.3. That could be one reason why ROEs currently are, where they are. Any plans to, raise further debt and take that debt to equity ratio upwards from the current point? And if yes, what are the plans there?
Yes, so we are investing about 3,500 to 4,000 crores in the next couple of years' time. Our earnings approximately are 500 to 700 crores. So net debt has to go up. So we do expect debt equity to go up over the next...
To what point?
I would say it can go up from 0.8 to 1:1 debt equity.